Hey everybody, Tim Albrecht here. Welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, I will give a shout out to YFP Planning's incredible team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. You can learn more and book a free discovery call by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Scott in Uniontown, Ohio.
Hi, this is Scott, a pharmacist from Uniontown, Ohio. And I was wondering, what are your thoughts about the best timing and what I should look for when purchasing a long-term care insurance policy?
Thank you, Scott, for submitting your question to be featured on this week's Ask a YFP CFP segment of the podcast. Tim Baker, what are your thoughts?
Tim, this actually might be the first time we've talked about long-term care insurance on the podcast.
I think so. Yep.
We're going to be recording a case study here that I think we'll talk about a little bit more in depth too. So I think it's a great topic to cover. I think it's one that there's a lot of kind of uncertainty around it, like black box. So just to back up, like what long-term care insurance is it's really insurance coverage that kind of provides a daily benefit. Sometimes it's like a monthly benefit for things like nursing home care, home health care, personal or like adult daycare for individuals, retirees that are 65 and older that have or are working through a chronic or disabling condition that typically affects things like bathing, using the bathroom, eating, being able to dress yourself. So that's really what we're talking about is coverage for that type of care, that type of assistance. A lot of people, Tim, assume that this is covered under Medicare, but it's not. It's kind of a huge gap, and really the people that are affected more or most by I guess lack of coverage is kind of like middle income individuals, because typically if you're a higher income, you typically have the means to either purchase, expensive policies and pay the premiums, or to self-insure. So kind of take, that money out of your retirement. Or on the other side, if you're lower income, Medicaid does pick up some of these, a lot of this cost. So there are instances where people kind of spend down their estate, and there's ways to do that, like, legally to do that. So it's kind of this middle ground, which I feel like a lot of listeners are going to be in that space. So, and the cost can be sobering, Tim. So Genworth did a study back in 2020 that shows for like the medium cost for like assisted living is like $51,600 for an in-home health aid. It's almost $55,000 a year, and then for a private room in a nursing home, it's north of $105,000. So again, if you're thinking about retirement and you have these, this kind of spike in expense that you're not planning for, the self-insurance thing can fly out the window. And I've personally had a family member that, if not for the long-term care policy, would have been, kind of in that destitute category, not really. But the problem is too, Tim, is that the policy, I think, was so good that the insurance company was kind of fighting the claim. So you're dealing with that nonsense as well. So for Scott's question in particular, the question is when what's the best time in and what to look for. So when I was always kind of taught like between like age 50 and 65 is kind of when you should start looking and nailing down a policy. I've seen that tighten up a little bit more between, age 60 and 65. The big thing that you're trying to kind of weigh and really thread the needle is if it's too early, you're paying, although the premiums are lower, you're paying premiums for a long time, right, that you might not reap the benefit. So if you're a 50-year-old, you might not actually claim or make a claim on that policy for 30 or even 40 years, if people are living longer, that type of thing. However, if you wait too long, obviously you're paying higher premiums, but there's also a chance that you could be denied coverage, because unlike health insurance, you can actually be denied for pre-existing conditions. So then you're kind of on your own, and then you're really stuck in that self-insurance, which again, one of the things with self-insurance is it's your own kind of dollars, but then what you typically rely on is family members. So the vast majority of of long-term care is provided at home by an unpaid family member or friend. And it's 80% of long-term care. That's how it's provided. So, and this typically affects him more. It affects women more than men because women typically tend to live longer. So it's typically, so the U.S. Department of Health and Services said someone turning 65 today has a 70% chance of needing long-term care services and support. It's 58% for men, 79% for women. Now, one of the things that always was kind of like cringe with these policies is like the rising cost of the premiums.
Yeah.
So I remember a client, selling these to clients, with my last firm, and, the premium would go up 50, 60% over a, 10, 15, 20-year period. So that's one of the main reasons is the rising cost of care typically equates the rising cost of premiums. And from the insurance company side,
Mm-hmm.
they're having to pay out these policies longer. So, they're pricing them, the premiums are being priced higher. So another question that, Scott asked is like, okay, well, what do I look for? So the big things you're going to look for is like, what's your underwriting class? So, the healthier you are, if you're in that preferred class, the better the premium is going to be. Are you looking for like a daily benefit or like a flat monthly benefit? Another thing that you can do to help with this is to put like a spousal rider on it. So
Mm-hmm.
if the policy is written for me and then I put Shay as a rider, we're kind of pulling that benefit that we can split. So, if we both need it, that might be problematic in terms of sharing that, but it's good. You have two people that are kind of, covered, but you're paying that one premium.
Yes.
So getting that shared policy with a spouse, making the elimination period longer. So we see this with like disability policies. Typically, if you can no longer feed yourself, if you can extend out and get help for 90 days versus like a 30-day elimination period where the benefit starts, then that'll lower your premium. You could reduce your daily benefit. So, you maybe not buy that Cadillac plan, but buy like, what do you think, from a bare essential? And then I think really kind of talking with your advisor, your insurance agent about what's the best path,
Mm-hmm.
how to best manage this. Cause it's a huge thing that potentially could be a major roadblock for people as they're assessing plans or policies and what's best for them.
Great stuff, Tim. And I think this is a topic I suspect is going to land with, many listeners, perhaps some that are in that retirement transition phase that are wondering about a policy for themselves. But then I'm thinking of the group that, may be caring for elderly parents or parents that are getting older, asking questions, having these conversations. And, as I think about my parents as one example, this topic of long-term care insurance, which we've talked about before, generally opens up a broader conversation about estate planning, all things that we should be discussing and making sure we've got an awareness of. Tim, one of the questions I have here is, not being too familiar with these policies, are these typically, term types of things where I'm going to buy, let's say, a long-term care coverage at, 59, and I'm going to purchase a policy for 10 or 15 or 20 years? Do these usually or typically go till, death? Are there variety? How do these work usually in terms of the commitment? Because I think for some people, they might be thinking of, depending on their personal finance situation, assets that they have, spousal situations, that maybe a policy that's more indefinite is better versus something that has a shorter period of time.
Yeah, most go for like lifetime.
Okay.
And, that's typically, but I think that they're written lots of different ways, and you can, I think what the insurance companies try to do is to write policies that, they can put riders or caps on things to make it affordable and make it, where it's kind of a mutually beneficial thing. So, most of the ones I see is like a lifetime, because typically, the older you get, the more, the more you need it. So if you're, if it expires when you're age 90, but then, you've been experiencing, some of these daily living restraints, then you're going to need that policy. So I think the other thing that, probably is out on the table is just like, should you have, this is typically a major needle mover with regard to premiums, is like, should you have like inflation protection? So obviously, like inflation being a big thing right now, sometimes there's a cap in the overall pool of money. So you could say, once this $100,000, is exhausted, then the plan is exhausted. So there's different ways to kind of look at it. And I think the biggest thing is to, talk to a professional that has your best interest in mind, and try to figure out, okay, if we carve out, this amount of premium per year, like what's the backside? I know like in my family, like my parents, it's like, they don't want, us to be burdened by them. So, and then, that typically is like, if you are self-insuring outside of your own, like I said, your own resources, you're typically looking for care from family members, which
Mm-hmm.
can be a huge burden on their own financial plan and obviously, life. But it's one of those tough things that you do really have to have a plan for. And unfortunately, a lot of people kind of overlook this part.
Yeah, and as you mentioned, you cited from the Genworth study. I mean, if someone's trying to, self-insure cash flow this, like those dollars can go quickly, really
Yes.
quickly. And
Yep.
and we talk so much about retirement planning and saving. I think about the building up of assets and, what are the experiences that we want to have in retirement and perhaps philanthropic goals and generational, transfer of wealth, but not something we may be thinking about too often is some of those healthcare expenses and what those will incur throughout retirement. So
Yeah, no doubt.
great stuff. And Scott, thanks so much for taking time to submit your question. We really appreciate it. We're going to be sending you a super comfy YFP t-shirt. And for those listening, we would love to feature your question on an upcoming episode. You can submit that question one of two ways. Go to yourfinancialpharmacist.com/ask YFP, or you can send us an email at info@yourfinancialpharmacist.com. As we wrap up this week's Ask a YFP CFP segment, an important reminder that the content in this podcast is provided for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. For more information on this, you can visit yourfinancialpharmacist.com/disclaimer. Thanks for listening. Have a great rest of your week.